Hello everybody, my name is Nicole Elliott and I'm a technical analyst and private investor. And I thought we'd sort of look at some stock indices today because they really have had an absolutely torrid time in March. I mean, US indices, to give you some idea, they had an average daily price moves of nearly 5%. So historical volatility is exceedingly high and implied volatility is unaffordable. It's what in dealer speak we call F-off pricing. It's like trying to get flood insurance when your house has been inundated 5 times in the last decade. So my first chart is a daily candlestick chart of the Dow Jones Industrial Average. So you can see that from the peak in February, it really started to tumble in March. Very quickly, we'd lost 20% of its value, and many people believe that is a sign of a market turn. Note that the moving averages have what is called a death cross, where the 50-day moving average has crossed below the 200-day moving average, another bearish signal. And then from the March low, we have bounced. We've bounced impressively. In fact, we've bounced quite a big chunk, more than 20%. But this is, the factor of this is the way the asymmetry of bear and bull markets, big numbers versus little numbers. You need a lot fewer points when you start off at a low to make 20% than on the way from the high. What we've done is now retraced initially 38% Fibonacci price, and now this week we've had another little leg up, so we've retraced nearly half the decline from the high, nearly half, but that's very much in corrected territory, as you can see. Now we've got Easter coming up, Good Friday here, it's a holiday in the UK, as is Bank Holiday Monday after that. We have a long weekend here, so I think markets, you can sort of put them to bed tonight and leave them alone and not worry about them. But do keep in mind that the rally that we've seen from the interim low could be classed as an A, B, C, 3-wave correction, and that we're likely to stall at the 50% level. Moving on to my second chart, which is a real sad little specimen. It's the Italian MIB index of the top 40 shares. Now, Italy only managed to borrow long-term money in the early 1990s, courtesy of the move towards the euro. And in fact, Italians only grasped the nettle and the bug for equity investing in the mid-1990s. And I'm afraid it's been downhill ever since. I mean, this quarterly chart, each candle is 3 months worth, so it captures perfectly the stress that we've seen in so many markets in the Q1 2020. You can see here that this is not an unusual move for Italian MIB. We've seen it many times on the way down since the year 2000. And what's extraordinary is how Fibonacci 38% secular resistance has capped for over a decade. So, I mean, this is not a bounce at all. This is just status quo for Italy. My third and final chart is a Brazilian Bovespa. This is a monthly chart. And what you can see is that the asymmetry between bull and bear markets, so neat on the way up, stuck in a neat little train track, everything going hunky-dory, and then suddenly it just unravels. This is the way it goes. This is the way things happen in bull versus bear market. We've now come back all the way down to where we were years ago, having lost 43% from peak of the index. The currency, meanwhile, has lost 33% since January this year against the US dollar. So US investors in Brazilian equities have lost a cool 76% of their cash. That's all for now. I'll see you soon. Good luck and happy Easter.